You're watching Silver News Daily. Subscribe for more.
You get up to about 34.95 and close the week there, and that momentum indicator I told you about says you're gone up. Price says you're exploding if you touch 36, triple top breakout. You see those, and I think you could almost double silver in a fairly short period of time.
The silver market is on the edge of a historic detonation, and almost no one is ready for the blast. Right now, in the background of a crumbling global financial system, a perfect storm is brewing, one that could send silver not just to new highs, but to a jaw-dropping $700 per ounce in mere months. Sound outrageous? Not to market veteran Michael Oliver. He's sounding the alarm, and the data backing his call is too explosive to ignore. A spiraling U.S. Treasury bond market, a dollar on life support, and a looming panic over physical silver shortages. This isn't a forecast, it's a warning. We've just witnessed silver test the critical $34.95 breakout level. If that level is breached and held, momentum indicators suggest silver's price could double in a matter of weeks. But here's the thing. While Wall Street laughs and shrugs, institutions are quietly loading up. They see what's coming. The last time we saw anything like this, silver went vertical, smashing expectations and rewriting market history. But this time, it's not just about a technical setup. It's about systemic collapse. T-bonds are imploding under the weight of $36.4 trillion in debt. Central banks are preparing for currency chaos. And physical silver? It's disappearing faster than ever. So why is this breakout different? Why is Michael Oliver convinced that silver isn't just set for a rally, but for a seismic price eruption that will stun the financial world? Stick around, because what's coming next might just change everything you thought you knew about silver.
Debt crisis. And I don't mean mortgages this time, I'm talking U.S. government debt. What if we're at that point now, where finally, after decades of ignoring and building on this error, the market says, okay, I'm going to pay dues. In which case, you've got a T-bond crisis. Now, what does that mean? Well, if the U.S. government debt or any other major central government's debt in the Western world, including Japan, let's say, and Europe, suddenly becomes a crisis, it takes a heck of a lot of money printing to try to stave that off, to try to keep that wave from crushing things, okay? And Powell likes to sit here and diddle his thumbs and act like, well, nothing's wrong because all the data points look good, which is, you get the point. They've got a problem. And the question is, what are they going to do about it? And what they do about it is to do what they normally do, which is to put the pedal to the floor, do QEs, buy government debt themselves, play games, et cetera, et cetera. But ultimately, it's an increase in the money supply, artificially low interest rates, all the things that are drivers for gold, and the degradation in the money unit that we measure things by, the dollar. And I don't mean degradation of the dollar versus the euro, dollar versus, I'll talk about the real buying power of the money unit, which, if you double its money supply every decade, which is about what we've done for the last 70 years, ultimately it means its buying power gets cut in half every decade. And meaning you could have a world where you're in Venezuela, where it really doesn't matter if everything is going up. So the stock people could say, oh, look, our stock market's booming, like in Venezuela where they print the money. It doesn't matter. It's the issue is what rate does it go up compared to the degradation in the money unit. So even then, at that point, when you reach that crisis level, it's conceivable. We don't think it's going to happen. We think stocks are headed down. But when they start printing money, the question is, will it become like a Venezuela situation? Whereas we have a crisis beyond crises, which means political turmoil, upheaval, not just here, but we're talking the rest of the world, which has similar problems. So that's what's driving gold, I think, and silver. And right now, I think that my own personal emphasis is on silver. As I said to you before, we watch the mama market, gold's the mama. But as long as old gold mama is going up, you can bet silver's going to go up in irregular fashion, more than gold, less than gold, more than gold, et cetera. I think we're at the phase now where it's about to go a lot more than gold.
The U.S. Treasury market, the backbone of global finance, is unraveling, and it's lighting the fuse beneath silver. For decades, treasuries were the ultimate safe haven, the place where capital fled in times of crisis. But not anymore. Today, The very thing that was supposed to guarantee stability is becoming the epicenter of risk. The United States is drowning in $36.4 trillion of national debt. That's a 122% debt to GDP ratio, the kind of number that would sink any developing economy. And now, as bond yields rise and rollover costs surge, the system is starting to buckle under its own weight. The Congressional Budget Office projects that debt levels could climb to 113% of GDP by 2032. But the market isn't waiting to panic, it's already reacting. Investors are dumping long-term treasuries, spooked by the Fed's tightrope act between inflation control and economic support. This isn't a crack in the system, it's a rupture. And here's where silver enters the frame. As the treasury market falters, the dollar's foundation begins to rot. With confidence in U.S. fiscal management evaporating, capital begins to search for real assets, tangible hedges against the chaos. That's historically when precious metals shine. But this time, the scale is bigger, the timeline shorter, and the consequences more severe. The collapse of trust in T-bonds is more than just a monetary issue. It's a psychological tipping point. And as this trust continues to erode, silver's appeal as a defensive and offensive asset only strengthens. The market isn't just watching the fall of treasuries, it's preparing for the shockwave that follows. And silver? Silver is about to ride that shockwave to levels no one believed possible.
I think that the trade issue is, of course, we know it's recent. Okay, Trump gets elected, and even then it wasn't a topic. It was only a few months later that it became a topic. I think it's a focal point that is, yeah, it's real and it's impactful, but it's not the prime driver of the markets. I think the prime driver of the markets is far bigger than that. I think it's monetary degradation. It's a government debt crisis that we're facing. Jamie Dimon spoke about that, the other day. Other people have said so as well. I think even Warren Buffett said, they would watch out for the U.S. government bond market. And that market we analyze closely, and obviously, it's bigger than the stock market. Okay, U.S. Treasury long end of the debt market. So it's very anemic. There's something wrong with it. In other words, back in 2020, when the T-bond futures were up at 170 and yields were real low, we got bearish in October of 2020. Well, it collapsed finally into 2022. Took a while to get going, but it finally did puke and got down to 117 from 170, 180 level. But since then, we're talking late 2022, you could just draw a line sideways. And it's tried to base, it made lower lows than that low since 2022, but only, it got down under 110, for example. Right now we're trading 112 on the nearby future. So it's very anemic, though. If this is a base, which we thought it might be several months ago, we had some technical reasons to assume you could get a strong counter-trend rally out of T-bonds, meaning a drop in yields on the long end of the debt market, which is the one the Fed doesn't control. And sure enough, we got a rally. If you'll notice, back in April, we shot all the way up to 122 on the T-bonds from levels that had been hovering around, 10 points below there. But in 2.5 days, it crashed from 122 back down into the 111s. Whoa, what happened? So instead of being an alternative to the stock market, it joined it. Now, in the week since, and the stock market has rebounded, bonds have stabilized, but they've not really gotten off the mat. They haven't gone down anymore, but right now they're going back down again. And when we look at the long-term charts, we know it's a negative trend. And we've given up on the notion of a, quote, counter-trend rally, where you get, let's say, a quarter or so of nice rally in the T-bond market as an alternative to stocks. Well, if T-bonds aren't an alternative, if they're not functioning that way, the 60-40 rule, which has now been broken fully, then that leaves only one alternative: gold. Historically, gold and T-bonds have tended to rally, advance during stock market bear trends. And the only one advancing now is gold. Well, why? Okay, forget the tariff issue. The government debt issues ballooned and ballooned decade after decade. It doesn't matter, Republican, Democrat, it just piles up. And the debt ratio, and so forth. We all know this. But nothing's ever really happened in terms of generating a...
As confidence in Treasury bonds crumbles, the next domino is already shaking: the U.S. dollar. For decades, the dollar has ruled the global economy. propped up by faith in American debt and the assumption that Washington would always manage its finances. But that illusion is disintegrating fast. Central banks around the world are watching the U.S. spiral into unmanageable deficits, and they're quietly making their move, dumping dollars and sprinting toward hard assets. Gold buying by central banks is at record highs. Why? Because they know what's coming. And if gold is the hedge, silver is the leverage. We're already seeing the consequences. The dollar index is weakening, inflation remains stubborn, and geopolitical risks are accelerating. The Fed is cornered, raise rates, and they blow up the bond market, cut rates, and inflation returns with a vengeance. Either way, the dollar loses. And as its purchasing power deteriorates, silver steps into the spotlight, not just as a hedge, but as a weapon. Investors are waking up to the reality that the dollar is no longer a store of value. With global de-dollarization accelerating and commodity prices climbing, the hunt for alternatives is intensifying. Silver has always been volatile, but in times like this, that volatility becomes opportunity. Unlike fiat currencies, silver can't be printed. It can't be debased by central bankers playing politics. And with the dollar now trapped between hyperinflation and credit collapse, silver's asymmetric upside is more obvious than ever. What we're witnessing isn't just a shift away from paper. It's a global dollar revolt. And when confidence in currency dies, people don't move to safety, they stampede. And silver is waiting at the end of that stampede.
There's a momentum structure when you plot a momentum oscillator of silver, where you measure silver versus like a 3-quarter moving average or a 40-week average. You'll have a corrective process since last year, since last May. So 12 months of momentum cooling off while price held steady. And there's a structure on it when you look at the momentum chart that says, ooh, if I cross that line, I'm going to blow through. We're challenging that line right now. About another 50 cents above where you are now, you're gone. I think the first leg in silver is highly likely to take out the old dual highs at 50, which again are really phantom historic situations. They don't mean much. They were decades ago. And go probably surge into the mid-60s or 70 zone, somewhere in there, before it even pauses. Now, I don't mean that's the top. I'm talking about this next gush could be a tremendous move, meaning a near double in silver from current levels. The key is to get up through today's high, which is like last I saw before we came on, was 34.65. You get up to about 34.95 and close the week there, and that momentum indicator I told you about says you're gone up. Price says you're exploding if you touch 36, triple top breakout. You see those, and I think you could almost double silver in a fairly short period of time, probably within 1 quarter. And again, that's not the top, that's not the end of the move, that's just getting up out of this historic silliness. Gold, after all, is well above those levels, right? You know, made a high at 850 in 1980, made a high at 1920, 2011, and it's 3,500 area. So silver hasn't done that. Now, silver to sort of match that would be up, $60, $70 level.
All eyes are on one number, 34.95. That's the line in the sand, the technical trigger that could send silver into a vertical liftoff. Michael Oliver's analysis isn't built on guesswork. It's rooted in decades of momentum study, and what he's seeing now mirrors some of the most explosive price breakouts in financial history. When silver approaches a level of resistance with rising momentum and tight consolidation, it signals one thing: the coiled spring is ready to snap. And right now, silver has been tightening around that 34.95 level like a pressure valve about to release. But this isn't just about charts. It's about what happens when technicals and fundamentals collide. The market has already tested this level multiple times, each time pulling back just short. That triple top isn't a ceiling, it's a warning. When assets break out of this kind of formation, the move is often swift, violent, and breathtaking in scale. Oliver suggests that if silver closes above this resistance, the price could double within 1 quarter. Think about that. A $35 silver price today could mean $70 before the end of summer. And if panic sets in over physical shortages, $700 no longer sounds like fantasy. It sounds like the extreme end of a probability curve that just got a lot more real. The momentum is building. We've already seen silver rally more than 18% year to date, with a pattern of higher highs and higher lows since 2022. The setup is textbook: accumulation, breakout, and explosion. And the fuel? It's coming from every direction: industrial demand, fiscal chaos, and a global run from fiat. If silver breaks 34.95 and holds, the algorithms will kick in, the traders will pile on, and the retail crowd will chase. This is the moment technical analysts dream of. And if Oliver's right, it's going to make silver's past rallies look like warm-ups.
No, we made a high. Actually, if you go back and look at a silver chart going back to 1970s, let's say, and you see the peak in 1980 at 50 area, which was, very gaseous type peak. And you were up there so briefly, it was thin air and then it collapsed, okay? And then in 2011, early 2011, before gold made its high, silver got up in just short of 50, like $49 or something, and then dropped and held. This time, when we're up here in the 30s, for the last year, in fact, last May, silver got up to 32.70. Okay, dropped, came back up in October, hit 35. They sold it, dropped, came back to 35 again in March this year, and dropped and had that flush where people sold silver thinking, oh, silver's going to go down because the stock market's going down, which is an erroneous assumption. And the people who sold that got killed because silver popped back over 30 in a heartbeat from 27.5, and now we're pushing toward the 35 again. Getting back to 35 is what point and figure chartists would call, triple top. Now, I use the word top. It really isn't that case. It's a pending quadruple top breakout, or a triple top breakout, excuse me. If you go up to 35 again, I'm going to bet the next tick is 36 and you're gone. That's what the price chartist at that point will start realizing, hey, this action of the last year in silver, which has been violent, but still with a slight upward bias. Go back to last May, it was 32, we're now earning 34.5, etc. They're going to realize, hey, we made a mistake. This isn't topping. It's been building a launch pad. Now, I don't trust price necessarily, so price says that. The only reason I would agree with myself about that 35 being a pending triple top breakout or a launch pad is that momentum says it is.
While the price charts are flashing green, the physical market is screaming red alert. Silver is facing a supply crisis that no one is talking about loud enough. And when this crisis hits the surface, it's going to send shockwaves through the entire financial system. According to the Silver Institute, the global silver market is set to experience a deficit of 117.6 million ounces in 2025. That's not a one-off. It's the fifth consecutive year of shortfall. And even though mining supply is projected to rise by 3% to 1.05 billion ounces, it's not nearly enough to close the gap. The real issue? 75% of that supply isn't even from primary silver mines. It's a byproduct of other metal operations. That means we can't just crank up silver production when demand spikes. The supply line is rigid, inflexible, and increasingly fragile. Now overlay that with ballooning demand from every corner of the economy, especially the green tech revolution, and you've got a perfect bottleneck. Inventories are being drained at a pace not seen in over a decade, and once physical shortages become obvious to the broader market, sentiment will flip from complacency to panic. And here's where it gets deadly for price suppression. When retail and institutional investors alike realize there's not enough metal to go around, the paper silver markets will face a reckoning. We've already seen hints of this. COMEX inventories have been steadily declining, and premiums on physical silver are widening again. That's the early tremor. The real quake comes when delivery contracts can't be fulfilled and the illusion of infinite supply collapses. This is the kind of scenario where silver doesn't just climb, it launches. And once the market collectively realizes there's a physical problem, not even the most aggressive central bank policy can plug the hole. The system is cracking from both ends. Technical ignition above 34.95 and a physical bottleneck below it. When those two forces meet, the result won't be a rally. It'll be a detonation.
Yeah, again, it's not high because, in nominal terms, $8,000 gold versus $1,920 gold. If we went to 8,000, an eightfold move from our bear low, which is 1,050, 2015. You think, well, that's crazy. No, it's not. It's just doing the same thing it's done twice before, eightfold moves. Now, but again, I'm not sure that's going to stop it. I think this bull market, one, is going to possibly go beyond that because of the nature of the government debt crisis. Remember, in the prior bear markets, we had a dot-com bubble, okay? It spent itself, 82% drop, and the NASDAQ 100 took it 16 years to come back to its old high. So it was a wipeout. But it was a market situation. Yes, facilitated by monetary manipulations and so forth over the prior years It created that bubble. And then we had the other crash, which was the 2007 to 9, but that was mortgages. Now we have government debt, and that's a different monster because the central banks can't just thumb their nose at it. They have to come in. Otherwise, I won't tell you what's going on the streets. You can't have that happen. So the question is, when are they going to push the button? Or are they already doing it? Some indications are that they are already intervening in the markets, especially the T-bond market. And when you look at the tonal action of that market over the last specials of the last 6 months or so, when it tries to drop, it suddenly seems to find a floor. It can't get off the floor, but it seems to find one, and it bounces, it keeps coming back down. Right now, again, bonds nearby future, which we treat as a September contract, is 112. Okay. You get down much under 111, like 110 area. It's a couple points, no big deal. It could implode. And that's when you'll have real panic on the part of the central government, meaning monetary excess, like possibly we've never seen. So again, what does that fuel? Gold.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell, comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. Silver's supply problem is bad enough, but when you add in runaway industrial demand, it turns into a full-blown crisis. This isn't the 1980s or 2011. The world has fundamentally changed. And silver is no longer just a monetary hedge. It's an irreplaceable industrial metal embedded in the very infrastructure of the 21st century. In 2024 alone, industrial silver demand hit a record 680.5 million ounces. And that's just the beginning. The Silver Institute projects that total demand will soar past 1.2 billion ounces in 2025, driven by a global surge in green technologies. Look at solar. Photovoltaic demand is projected to jump by 20% to 232 million ounces. That's nearly a quarter of all annual silver use, gone to power the energy transition. And it's not just solar panels. Electric vehicles are gobbling up silver for batteries, inverters, and onboard electronics. AI data centers and grid upgrades require silver-rich components to handle rising power loads. These are not fads, they're government-backed mandates and trillion-dollar megatrends, and silver sits at the heart of them. Now here's the brutal truth. There is no substitute. Silver's conductivity, reflectivity, and thermal efficiency make it unmatched in these high-tech applications. Engineers have tried alternatives, but nothing delivers the same performance at scale. So as demand explodes and supply remains chained to byproduct mining, we're heading into an unprecedented imbalance. This is what makes Michael Oliver's prediction so terrifyingly plausible. When speculative frenzy collides with real-world scarcity, the price mechanism doesn't just adjust, it breaks. And when you have billions flowing into a market that physically can't absorb it, silver doesn't go up in stages. It reprices violently. We're not talking about a gradual climb. We're talking about a runaway scenario where industrial buyers, investors, and even governments are all scrambling for the same limited ounces. That's not a rally. That's a feeding frenzy. And we're already seeing the first ripples.
Also, the gold and silver miners. My personal emphasis in my own trading is long gold and silver miners, long silver. Watching gold is the mama, but again, I think those two categories, subcategories of gold, we know they've underperformed for the last 3 or 4 years. Then that 2020 price surge we had in gold went up to 2,000, silver went up to near 30, and the gold miners, GDX, went up to 45, I think it was. Then gold sort of went sideways for a couple of years, but silver and the miners went into a staircasing decline. So since 2020 through the present, the spread relationship between silver and the gold miners in gold has been underperforming. Technically speaking, they look like they're ripe to turn up. In fact, the gold and silver miners right now are on the edge of breakout. In other words, if you plotted that action, the spread action since 2020, so fairly long time, there's a structure on the chart you can see, and you're trying to break through it right now. If you do, it'll validate what I'm saying, further validate it, that the place to be is silver and the gold and silver miners. And I think they'll gush a lot more than the upside than will gold. I don't think that we're in a normal bull market. That I'm not saying that you've got to go a lot higher than the other ones did. I mean, even if you just matched the prior gold bull markets, which were 8-fold moves from bear low to bull high, you'd be $8,000 gold just to match those peaks. The $850 peak versus its $100 low that preceded it, or the, et cetera, et cetera. But the reality out there, aside from just markets, like political reality, economic stability, monetary notions, institutions that have helped create this crisis, like central banks monopolizing the production of money, that could end. And I think we'll end up in quite probably a gold, silver world again, where it's money, it's legal. It can't be printed overnight at the will of government to pay for this program or that program. By the way, I noticed the other day, Florida, of course, legalized gold and silver as tender, as legal money. They're like the dozenth state to do that in the U.S. Now, when a state government legalizes a new money, gold and silver, in effect, that's saying to the central government, we're seceding from your monopoly control over what we call money. We're allowing gold and silver to compete with your, quote, legal tender. So in a form, that's a form of rebellion, quiet and peaceful, but it's a way to say, hey, we're tired of your money. It's not stable. It's never been stable. It's always been degrading in value. We're allowing the public to use gold and silver as legal money. And even some of the states are allowing you to pay taxes with that. They're setting up agencies to be able to accept gold or silver in payment for taxes. So that's the kind of rebellion I'm talking about that occur globally, where there's a transition among the more foresighted countries that we need to get away from this stuff. It hasn't been working. And so I think that...
But here's where things get truly unstable. The paper silver market. COMEX, the world's leading silver futures exchange, has become a ticking time bomb. On the surface, everything looks orderly. Daily volumes are high, open interest is strong, and liquidity appears abundant. But scratch beneath that surface, and you'll find a system built on leverage, not metal. COMEX trades more paper contracts in a week than there is physical silver available in an entire year. As of June 2025, the average daily volume is over 102,000 contracts. That's more than 500 million ounces traded daily, while global annual mine production is only 844 million ounces. It's not just a mismatch, it's a powder keg. Why does this matter? Because the moment physical delivery becomes even moderately constrained, the entire illusion of paper-backed silver implodes. Weekly options now account for over 20% of total trading volume, increasing the speed and volatility of price movements. In a market this leveraged, if investors start demanding real metal instead of settling in cash, the system breaks instantly. Think back to the 2021 Reddit silver squeeze. It was a spark. What's coming next could be the firestorm. And right now, that fire is spreading. Premiums on physical silver are quietly rising. Bullion dealers are seeing rising order backlogs. And institutional interest in taking delivery, not just trading paper, is accelerating. Why? Because smart money sees the cracks. They know that when silver breaks above key technical levels, momentum traders will pile in. Retail will follow. And then the scramble begins. Not for paper promises, but for ounces that don't exist in sufficient supply. If just a small percentage of COMEX participants demand physical delivery, it could force a historic short squeeze. And if that happens in tandem with the industrial demand surge and a weakening dollar, the result could be a vertical price explosion that defies every previous silver bull run. This isn't just market speculation, it's structural vulnerability, and it's setting the stage for the most violent silver repricing event we've ever...
It upticked last month, and we got down below 1%, meaning if you divide an ounce of silver into an ounce of gold, the April closing level of that spread was like 0.9 something percent, less than 1%. Now, historically, you go back 50 years or so, and the number of times you find that silver prices, 1 ounce of silver is, 1% of the price of gold, is very rare. And whenever it does it, it's a buy. I mean, if you go back and you found those times and circle them, somewhere around that time is a major buying opportunity for the net price of silver. Because when that spread goes up, it's always the case that it's silver going up more than gold, not gold going down more than silver, if you get my point. You could have the silver-gold spread favor silver in a bear trend, but it doesn't work that way. It never has. It's always the case that when that silver outperforms gold, it means they're both going up, just silver more. Technically, when we analyze the spread action, not just look at the chart superficially, right now we're back above 1% again. We had a slight up month last month in the close of May, slightly upticked from the, not enough to change the tide. You get back above 1.1%, which is not asking a lot. Wake up, because that indicates that probably it's starting its turn. You ever get above 1.32%, you can write this down if you want. Divide an ounce of silver front month active contract into gold's front month active, and you get it up to 1.32% or higher. I think you could gush to 2% in a heartbeat. Now, what does that say? Well, if you hit those trigger levels, that's basically a doubling in the current price of silver versus gold. So if gold ever went to 8,000, it's a normal, eightfold move again, and silver would doubly be $160, 2%. So you get the point. I'm not projecting that as a price. I'm just saying that's the kind of dynamics we're dealing with here. And we're very close to signaling that type of turn, both in the miners versus gold, which I said we're at the structure now, or in fact, we're probably crossing it today, and silver versus gold. And quite often, as you pointed out, it's later in the bull trends that we see that type of behavior where they go berserk, more so than gold. And I think we're on the cusp of that.
Now layer in the final accelerant, central banks. These institutions, often dismissed as slow-moving and conservative, are quietly engineering one of the greatest wealth transfers in modern history. Over the past 2 years, they've been hoarding gold at levels not seen since the 1960s. Why? Because they see the writing on the wall. The dollar's dominance is crumbling, fiat confidence is deteriorating, and inflation is proving far more persistent than policymakers ever anticipated. And while gold grabs the headlines, silver is the unspoken wildcard in this global monetary reset. The signals are all there. Central banks are diversifying away from treasuries, easing monetary policy, and publicly criticizing the risks of over-reliance on the U.S. dollar. When they cut rates, they weaken their own currencies, driving capital into tangible assets. When they buy gold, they're indirectly promoting the value of hard money over fiat. And silver, despite being ignored by central banks' indirect purchases, is moving in lockstep with these trends. As inflation remains sticky and rate cuts begin to accelerate, silver becomes the ultimate retail play, undervalued, overlooked, and ready to explode. This isn't theoretical. Tariff disputes, geopolitical shocks, and fiscal gridlock in Washington are already impacting currency values across the globe. The Fed is boxed in. Raise rates, and they risk detonating the debt market. Cut rates, and they risk igniting another inflation wave. Either choice weakens confidence, and in that vacuum, silver shines. Because it's not just a hedge, it's a verdict. A verdict on unsustainable policies, uncontrolled debt, and over-leveraged markets. So as central banks continue their gold binge and fiat currencies spiral toward competitive devaluation, silver stands to benefit in ways few are prepared for. It's not just a reaction. It's a reflection of a system in decline, and of the coming rush to the only assets that still hold real value. The stage is now fully set. The fuse is lit, and the final chapter begins next.
So the banks, okay, the lenders, okay. We're watching particularly commercial real estate, not home mortgages and stuff. We know that's hurting, and we know it's the high yields are discouraging new home building and so forth, because it's, that's the end of the market that matters. But commercial real estate, there's two ETFs, RWR and VNQ, that cover the commercial real estate holdings. And they both tend to be technically in sync with each other, those two ETFs. First off, they're much heavier than the stock market in terms of what they've done over the recent years. Like when the S&P went up finally and took out its 2022 price high, which was 4,800 level, and went all the way up to 6,100, pulled back to 4,800 recently, by the way, for a bounce, which we expected. If you look at RWR, VNQ, they never even approached the 2022 high. They rallied with the stock market, but they were still well below the high that the market general made in 2022, from which it declined. They declined too, but they never even got back to the 20. So they're very anemic. We understand, and I don't look at the fundamentals, but I hear analysts who know the sector. The debt there is a very big problem with commercial real estate. In fact, about 2 months ago, we had, I think, the largest shopping center in the country or something. It was, forget the name of it, New York, that defaulted on $300 million in debt. Okay, so, it's that kind of thing that could then shin kick the banks. Now, of course, the feds are going to be there, okay? The banks are part of the deal, they're part of the club. So they'll come in, but still, that's an area to watch because it will indicate the internal consequences of high yields. Which these high yields on government bonds are impacting commercial real estate. Debts are due now. I understand a lot of the debts with commercial real estate are due in 2025, 2026, and the yields haven't dropped. And so they're choking. And that could lead to a domino effect. So yeah, I would watch the banks, but again, watch commercial real estate because it's likely to be the domino that hits the banks. And it's an anemic sector.
This is the convergence, the moment where every pressure point we've explored collides in a single explosive outcome. The imploding treasury market is eroding the very foundation of global finance. The dollar, once the ultimate pillar of trust, is being abandoned in real time by the very institutions that once propped it up. Physical silver is vanishing from vaults, while demand from both industry and investment reaches levels the market simply cannot sustain. Momentum is building, charts are screaming breakout, and COMEX leverage is becoming untenable. And through it all, central banks are quietly executing their endgame, hoarding gold, softening currencies, and preparing for a new monetary order. Michael Oliver's forecast of $600 to $700 silver isn't outrageous. It's the logical conclusion to a market under siege from every direction. We're not talking about some far-off scenario. We're talking about the next phase of a breakdown that's already in motion. Every time silver approaches resistance, it comes back stronger. Every time supply dips, it dips lower. And every time trust in fiat evaporates, silver's case becomes unshakable. This is the beginning of a repricing that could shock even the most seasoned investors. If you've been watching the signs, debt explosions, inflation waves, disappearing physical inventory, you already know what's coming. And if you haven't, now is the time to pay attention. Because when silver takes off, it won't be slow. It will be violent, dramatic, and nearly impossible to catch once it starts running. The financial world is on the edge of a historic reset, and silver is no longer just part of the story. It is the story. If you want to stay ahead of this seismic shift, make sure to subscribe. And remember, this is not financial advice. Always speak with a professional before making any financial decisions.
Yeah, I forget the details of it. There was some big, huge old office building in St. Louis. I think the whole thing sold for like the price of a rich house. And anyway, you're right. Yeah. So reality's changing, and we have these cadavers, skyscrapers. Anyway, yeah. It's that reality, the long-term government debt market, the bond market, U.S. government bond market in particular, is impacting this private debt, and therefore I don't see a recovery out of it. I don't know how they're going to get out of it. As far as commercial real estate goes, they'll have to change the nature of their reality that they deal with. And the long-term debt they've got is just not getting better. And if this T-bond market doesn't stop, and I think Buffett and Jamie Dimon have both said, we're negative on this, and we've been, I agree. That's a crisis, and it's a monster. We're talking U.S. government long-term bonds. They're bigger than the stock market. So pay close attention to their tonal and behavior, because they look like they could, if they don't stop here shortly, they could have a spike to the downside that would upset the heck out of people, including the central bank. So, I don't know. Of course, Powell's created he's got his own problem because Trump says cut rates. Trump has always been that way, print money. Okay. And it's one fallacy in his intellectual structure is He believes, yeah, he told the Fed back, years ago when the last year in his term, take rates to 0 or lower. If Europe's got them real low, we can should go lower. So, he believes in that. And he's pounded Powell in the head about this. And Powell, of course, has to resist, because otherwise he looks like he's a puppet. And so by delaying, it compounds the situation. It's going to be interesting. But again, this is a crisis different from the other bear markets because the factors that are engaged here are much bigger. The bubble in the stock market is much bigger. It's much older. It's 15, 16 years old, far bigger than any bull market we've seen. And if you look at a money supply chart or the Fed funds rate chart, you can say, oh, I can understand why.